Financing cash flows. Useful for predicting claims on future cash flow by providers of funds. So are you borrowing money? Are you raising money through the equity markets? Are you paying back debt? Are you buying back shares? So it's all pretty much how you finance the business, which is why they're financing cash flows. So in the previous example, the small one we had, they bought back shares, and to do that, they issued debt. Reporting of cash flows operating. Now, with this, we primarily focus, and as we go through the rest, actually all of them, operating and investing financing, we pretty much focus on gross receipts and payments. There are going to be times when that's not necessarily the case, but that's pretty much what we'll focus on. Now, in first year, you do cash flows in first year, right? Yeah, so, I mean, I know that depending on if it's full-time or part-time, that may have been a while ago. But you looked at both direct and the indirect method from what I understand of what you cover in that first year subject. That'd be yes, no, what's an indirect method, what's a direct method. Hopefully some of this will jog your memory. But there are two methods for reporting operating cash flows. There's the direct method, which is, let's just start from a zero base and just create numbers. So I received cash from customers of $100,000. We start with plus $100,000. I paid my suppliers $70,000. I have negative $70,000. I have cash flow from operations of 30. So that's the direct method, and it starts from a zero base. The indirect method is where you start with net profit, and then you take out all those non-cash effects. So you add back depreciation expense. You adjust for changes in accounts payable and accounts receivable. I showed a portion of it in relation to the Qantas accounts at the start of the lecture. Have a look at an indirect method cash flow statement. Now, Australian companies for about the last 4 or 5 years have been allowed to use both methods. US companies under US GAAP can use both methods. International accounting standards allow both methods. What was interesting though was Australian companies, even though international standards in 2005 said you can use both, for the first 4 years or so of that, Australian standards did not allow you to use the indirect method. They said you had to use the direct method in the financial statement you provide, and you must provide a reconciliation in the note disclosures. As of 4 years ago, Australian companies could choose between the direct method and showing an indirect reconciliation, or showing the indirect method on the front, and that's all that they have to show. Now, the only reason I mention this is in the US where they can use both, and even the standard setters have said, we strongly recommend that you use the direct method. Even though analysts say we strongly recommend you use the direct method, and there's been a lot of research on this looking at that, basically no US company uses the direct method. Even though everyone wants that, they don't do it. In Australia, where we've had it for the last four or 5 years, even though they could choose both, basically everyone chooses the direct method. No one has switched to using only the indirect, which means for us, we are only going to look at the direct method. So from an operational, here and now, what's useful in the next 3 weeks, you don't have to worry about the indirect method for us. That is not to say it is not useful to understand how it works, but that is up to you to make that decision. Reporting of cash flows for investing, financing, gross payments, except in some circumstances, have a look at that, and report by major classes. So that's relatively straightforward. Now, this is where it gets a little bit difficult, because the standard doesn't tell you for either interest, dividends, or tax where to put them. Companies can actually choose where to put those amounts, which, as one takeaway, is you cannot simply compare the cash flow from operations from one company to the cash flow from operations for another, because they may have done something different with their interest. And that's one which you do see in different places. So if you're ever comparing cash flows, if you're ever looking at the different components of cash flows between companies, you've got to make sure that they're actually including the same things in the same places. Otherwise, you're comparing apples with oranges. Now, We'll focus on interest. On one argument, you can say it makes sense to put it in operating because we've borrowed money. Without borrowing money, we're not going to be able to fund the business and keep things going. So it kind of makes sense to have that as operating cash flows. On the other sense, we've borrowed money, and that borrowed money would be counted as a financing cash flow. So should we not have the money associated with paying back that debt included in the financing cash flows, because that's where that loan money came from? So why not have the interest component put there? You could argue that, was it borrowed money to finance a qualifying asset, in which case in the profit and loss and balance sheet, you're actually capitalizing that interest cost against the asset. Assets and purchases of property, plant and equipment and sales of property, plant and equipment go into investing cash flows. So maybe that interest payment is related to investing cash flows. And the standard allows you to pick one as long as you're consistent. And that makes sense because what they're worried about is the economics of it, not necessarily you have to do it here. Same with dividends. Tax, as they say, generally treated as operating, so that will be the default, but it could go elsewhere.